Hello, YouTube. Happy Sunday. Tomorrow morning, I'm going to purchase shares in YEXT. The company name is the same as the ticker. It's YEXT. And I thought I might share a little bit about my decision-making process, why I'm going to make this purchase in case it's useful. And maybe you'll be inspired to take a look at this company, in which case I hope I don't need to say you need to do your own homework, right? I can't recommend, this is neither financial advice nor investment advice nor a recommendation to buy the stock. I can't recommend you buy the stock. After all, I don't know your portfolio. I don't know your risk profile. YEXT, I will show you, is a risky stock. And so there are many investors for whom this would not be suitable, would have no business being in their portfolio. You need to do your own homework. That said, I like the company. And if this is a helpful video, please leave me a comment, which will encourage me because I don't do too much of this ad hoc sharing about my own portfolio. I grabbed a shot of their brand new global corporate headquarters in New York. I read that it's going to house up to 1,000 employees and has a state-of-the-art customer briefing center. I would hope to visit that one day. And just for context, so you know, I already own 600 shares. I only became aware of the company around about the beginning of the year through Seeking Alpha, followed them for a little bit, and then on March 4th decided to buy 600 shares. So you can see right here, I bought 600 shares at $19.30. And as of the close Friday, that's the day before yesterday, the price closed at $18.36. They reported their quarter on Thursday. That's why I'm doing this video, right? And that's why I'm purchasing more shares, because I've now read the SEC filings and the earnings transcript. So I'm adding to my position. They turned in a fabulous quarter. The stock jumped immediately, and except that then the president tweeted that thread about hanging a potential tariff on our trading partner in South Mexico. So the whole market sold off, as I'm sure you know, dramatically on Friday, and YEXT is caught up in that and actually caught up quite a bit. You can see down 4%. And this does reflect the fact that this is a high-risk stock, right? It's what we call a high beta stock, and I don't just mean market beta. There's sector and industry beta. As a small-cap cloud company, there's a lot of guilt by association on a daily basis. So when the market panics, it punishes a company like YEXT. High sector beta, although personally I don't care at all about daily returns, but you can see I'm underwater $600 and my position value is about $11,000. And that's pretty much my MO, right? When I start a position at $10,000 to $12,000 because that's where I want to start, because that's a meaningful motivation to me. That focuses my intention. That is my commitment that then we're going to learn more about the company over time. Core to my philosophy is that one of my only advantages is patience, along with my valuation discipline and my willingness to process the fundamental information. I require of myself that I be patient. What does patience mean? It means that, well, there's two things I don't want to do in a hurry. I don't want to buy in a hurry, and I don't want to sell in a hurry, right? So that does mean, yes, I may miss some opportunities by not jumping on something quickly enough, but I'm a part-time investor, and as part of my patience, I want to do things gradually, both purchase and sell. So even if I'm wildly optimistic about a company, I would only start the position at $10,000, and then that's just the beginning of a path to learning more about the company, right? So as they turn in the quarterly performance, I make sure that I read the SEC filings and the earnings transcripts in any investor's days, important fundamental inputs for me and my valuation discipline. So for example, my largest holding is in Structure, ticker INST, and I've owned them for a while. I'm sitting on a paper gain, but I started first position at about $10,000, and then I've added gradually over time. I think in 4 or 5 or maybe 6 tranches. And then I reached the upper limit on my single stock position limit. But I did that gradually, never in a rush, right? Not even when I was initially first really optimistic about it, I still felt like, well, my ignorance always exceeds my own knowledge, so I never rush into anything. But over time, The original thesis is still intact. The valuation is still terrific. My risk-reward profile is fantastic. It's really low volatility, and I'm already sitting on a gain, so that's just fine there. So for YEXT, I have the one position. I'll add to it. I don't know how much I'm going to add Monday because in December, right, I really doubled down with the portfolio, went almost all equities in the sell-off, including really increased my home builder exposure, which has been good so far. So I actually need to sell something from the bottom of the barrel in order to fund increased exposure to YEXT, which I like even more now that I've processed the quarter. So I might sell Volkswagen. They're near the bottom of my barrel. I'm not quite sure yet. So briefly, YEXT, what are they? Well, they say they have invented or defined the category of digital knowledge management. So their customers tend to be large corporations with global brands who need to manage that brand in the internet age, right? They have said somewhere that they want to be the single source of truth for their customers' brands. So the brands can log into the portal and go and manage how that brand is appearing to customers across the online spectrum, not just search, but in other channels, other applications, chat, and also, importantly, in the emergent voice. So on the call, the CEO talked a lot about one of the trends that they're capitalizing on, and this is the shift from, let's see, browsing to asking, right? Classically, we think of Google and we put in a keyword and we get a list of results and we click through the results. We browse the search findings. His point is that we're shifting more into a world of where customers are asking questions, not just of Google, but maybe of their voice-enabled device like Alexa. So they're asking questions, which even in the search, interestingly, even for the search bar, is a shift from a single keyword to multi-keyword, like questions in the form of sentences. So they're asking queries and they're getting back increasingly responses to the queries instead of a page or pages of listings. It makes a lot of sense to me. And so they're helping their customers manage how they show up in those questions or queries. Related, part of that in serving up responses is structured data. I think so. Here, I'll just put a question mark for that. Structured data. When I structured data, I think of XML, and if you think of even Google or even Yelp, or for example, pulling up a query on a restaurant, increasingly you'll see their hours and maybe even their menu. Well, that's structured data being served to you. So these brands need to manage how they're showing up in the structured data that's increasingly be served as results to the customers. So this looks to me like very much a winning theme, and YEXT is one of the few obvious players you can find in the space. Very hard to find competitors for them. In fact, you might think, my thinking is that one potential competitor would be Google and Facebook, them being in the search business. But it's not so obvious that Google can take over this business. For one thing, there'll be regulatory concerns. And for another thing, YEXT is in the business of being an ambassador, an agent for their customers who are managing across several different channels, an important one being Google, but by no means being the only one. So it's just not obvious to me how Google can swoop in and take over this market, or Facebook for that matter. In the meantime, they appear to have very little obvious competition, and I'm not aware of a single pure play public company that would be direct competition. Customers include many global recognizable brands like T-Mobile, Jack in the Box, McDonald's, Hilton, Marriott, and Chase. They have a very strong reputation and penetration in food and retail industries, but also they're growing in verticals like finance and healthcare. And in the quarter, like they've been doing in recent quarters, they added a lot of new logos, 50 logos in this quarter. And what they said about this is, During the quarter, we signed contracts of leading brands like Daimler, famous brands Rogers Communications, Jiffy Lube, Sephora, WH Smith, and we signed expansions and renewals with Choice Hotels, Jaguar, Allstate Insurance, and Adidas. And so the reference to renewals is significant because relative to some of their SaaS peers, SaaS again is software as a service or cloud companies, some of the SaaS companies have longer term contracts, and so that would make them stickier. With YEXT, their contracts they've said are 1 to 3 years with their customers, meaning they need to renew these contracts every 1 to 3 years, not as sticky as some of the cloud peers, so you might view that as a risk factor. So the income statement is very strong, right? They've consistently grown revenues. That's both quarterly and annual. On any quarter or annual look, as far as I can tell, they've grown revenues at least 30%, sometimes 35%. You can see Stockopedia is telling me that the CAGR is 36.5% per annum. And so if that looks like a no-brainer, it's really not a no-brainer, right? It continues to be a risky stock because, again, we have negative profits and earnings per share is negative and not exactly closing in on the positive EPS yet. The market cap, I don't think I've mentioned, is $2 billion, which technically is right on the border between a small cap and a mid cap. I would tend to classify them as a small cap so that we appreciate their risk as a small cap cloud company currently unprofitable. And in terms of the market's expectations, I think you should know that the market does really expect these cloud companies to grow at least 30%. Sometimes I feel like the expectation is 40%. That's significant because it means if there's a disappointment there, they tend to get punished, right? And I saw this just Friday with this last week with my other, with Zora, my subscription-based holding. They turned in a great quarter, but they lowered the forward guidance is all, right? Nothing to do with the quarter, the good quarter they turned in. Good, not great. And then the forward guidance they lowered from plus 24 to plus 17%, right? So they're in my peer group here, and so you can just see they market punched them 30% on that single day, right? For bringing the guidance down to 17% gives you a sense of some of the expectations that exist. And, it's not unreasonable. They're unprofitable, right? So do they have a path to profitability? Now, given that risk, YEXT, this is a key part of why I'm buying. This is, I think, the fourth or fifth quarter they've turned in positive operating cash flow. So that's actually better than a cloud peer would be at this point. Their cash flow performance, as far as I can tell, is excellent. And this is a key indicator reflecting on the unit economics of the business. And so the cash flow profile leads me to believe that there's a clear path to profitability. And although I don't know when the reported EPS is, given this growth and size, it's not something that I would expect, for example, next year. Balance sheet also looks fairly healthy to me. They added additional cash in the last quarter on the balance sheet because they went out with a primary offering of, I think, 7 million shares. Had no trouble doing that, although I think as usual the market had a negative reaction in the moment to that raise. Apologies, you can't really see the cash flow statement because I did this quickly, but this just reflects the operating cash flow here. That was the year over year. First quarter, the quarter in 2018 last year was actually 1.4 million, so it's down a little, but still negative at almost 820 or so, almost a million positive operating cash flow. And you probably can't see it here. Here's their proceeds, 147 million from that stock offering. So I like them. I like the income statement. I like the balance sheet. I like the cash flow, and I like the quarter that they reported, which I summarize here for you. Bring up my spreadsheet as well. Revenue for the quarter, 68.7 million, plus 35% year over year. So that means over the same quarter last year. And in this case, so that'd be over Q1 2019. Gross profit up even more, which is consistent here with what I would call a a bright green flag. Gross margin of 76%. This is something that the professional analysts follow, especially with these cloud companies. They want to see trends in the margin because it speaks to the unit economics and gives them a lot of evidence on the path to profitability. And here we have perhaps the highlight of the quarter. Gross margin expansion of over 100 basis points. Already was high, up to 76 points%. So I love the business model. I love what the income statement is saying about the business model here. And then in terms of the guidance, the next quarter, let's see, for the quarter, this guidance to me, according to my calculations, is plus 29%. So a little bit below that 30% that we've come to expect for them, but fine. And then the fiscal year guidance, as you probably know, this is something that the analysts pay a lot of attention to. Or I don't know how many analysts are actually following this company, but so the fiscal year guidance is 300 million or just shy of it. And so I'm getting that's a guidance of 31% fiscal year guidance. So that looks to be strong. EPS, they're forecasting again, reported loss. I think, I didn't quite check that, but as my memory serves, that's about flat. I think it's about where it was. And would not be my obsession, right? I would not be obsessed with, frankly, I wouldn't care what happens with EPS, as long as it's not dropping off, as long as the cash flow and balance sheet indicate that this is going to be translated eventually into positive reported EPS. And certainly if these 30% trends persist with this kind of margin, that won't be a problem. And so let's see, if I had the highlights, I think I've already emphasized the gross margin. The fact they added 50 logos, a couple of the two major events that they shared, or qualitative events. They've deployed these so-called smart landing pages that are driven by artificial intelligence that are especially relevant to serving up search results, or what we could call sort of search results, to Chinese consumers who have a different experience than we do. So it's helping their customers reach the Chinese market. And then a partnership with Adobe. I think this was even a deepening in a partnership, or the announcement of a formal announcement with Adobe, where YEXT can be integrated into some of Adobe's tools. And so I think that's a very positive development. Basically, YEXT extending its reach to even Adobe's considerable customer base. And so finally, of course, valuation. I look at evaluation a lot of different ways, but I'm just going to quickly summarize, because for these cloud companies and the most common one is probably price to sales. And so that's always a question of, what sales, current trailing sales, forward sales. But so typically, like if I'm running an article, I'll do a price to forward sales, but I'm just doing a quick check here with Stock Rover, and it's a price to trailing sales. So this would be more conservative. And YEXT, very hard to see here, because I basically have most of my SaaS peers that I think are relevant to YEXT, and also includes in structure here. I thought it did. I think it includes Instructure at some point, but the YEXT is somewhere right about here. Trailing, that's price on 12-month trailing stale of about 7.6. So I think the forward price to sales is probably less than 7 forward. And down here near the bottom, and I just know from tracking this group that the price to sales, sort of a competitive range, tends to be 10 or more. I prefer to buy in at less than 10, but I'm calling this an attractive valuation. You can see some of these high flyers where the best performance is arguably behind them. They're actually getting up to price and sales higher than 20. And, that's where my valuation kicks in. I just couldn't own like a Shopify. Would have loved to got it earlier, but I couldn't get it today because from my perspective, right, if the market could punish them with a 50% drop, bringing them into a competitive price to sales, and they would be justified. Although I say that without knowing Spotify's particulars, but at to 7.6 price to sales trailing, valuation continues to be attractive given the other parameters. So for these reasons, I'm going to add to my position on Monday. I'll let you know how it goes. Thanks very much.